may not have the luxury of easing.
I agree with you. That is to say, the Fed's had a 2% inflation target for some time now, and while inflation's come down nicely, it's nowhere near 2. Oil prices have headed back up. And so there's sticky parts of inflation. Wages probably going to be there. Look, I think tomorrow we'll get a mixed report. A lot of things will be behaved. Oil prices probably up, and so we'll get a number that's not so sure it's the Fed finished. My guess is they'll go one more time before the end of the year. But what's more important than whether the Fed's done or not is what have they already done to the economy by raising rates from 0 to 5.25 in 18 months? Those leads and lags are unpredictable. And my guess is we've only begun to see economic weakness from those actions.
There's been a lot of discussion, though, at least the Fed would make this argument. And I know Jay Powell has said this at one of the press conferences in the past, this idea that if they weren't as aggressive as they had been, then the impact of inflation on consumers would have been much worse. And we've already seen some data, Bob, showing that just overall on an inflation-adjusted basis, household net worths, household incomes actually declined last year pretty significantly here. So there's this idea that while a lot of people are getting raises, a lot of people are, at least on the surface, in a better position financially, the inflation is just eating away at those gains.
No question about it. Now, remember, the Fed waited a long time to get started. The whole debate is inflation transitory or not, and it's clear it wasn't just transitory, so they had to make up for lost time and got moving pretty quickly, as you point out. But of course, with the stock market up this year, home prices doing reasonably well, a lot of those net worth numbers have moved back up, Romaine. So I think that consumers are probably feeling pretty good. Many of them still have excess cash from the pandemic, although that's winding down fast, too.
When we talk about, I guess, the corporate fundamentals, Bob, and the idea that we came into this year, everyone sort of expected we were going to really see a lot of pain on the earnings front, and we didn't necessarily get that, at least not in the broadest sense here. We're heading into another earnings season in a few weeks, Bob, and I think by most estimates, we're still expecting a lot of these companies to still post relatively decent margins.
There's no question the first 2 quarters of this year, I'll put it this way, earnings came in less bad than feared. They were down both quarters, make no mistake about it, but not down as much as people thought. And in fact, in the last 2 or 3 months, we started to see full year numbers move up a bit. That's the first time we can say that in a while, and that's a function of economic growth's been pretty good. My guess is with the cost pressures that we've just talked about, we're going to see some pressure on corporate profit margins. So I'm concerned one more time that earnings are probably not going to make the up quarter that people are hoping for in quarter 3.
So if you add that all up, we were talking about how the Bank of America Global Fund Manager Survey showed that a lot of investors are betting against Chinese stocks. Where are they going? They're going into U.S. stocks, specifically big tech. Where does that leave us with that outlook you've just given on corporate earnings and this propensity to double down on U.S. stocks, particularly big tech?
So I throw into the equation Scarlet valuations. Valuations are not inexpensive. Remember, interest rates and inflation are no longer 0. When they were, having PEs over 20 times made sense, but not so much now. So I think a lot of that money that's come running in is going to need to see the fundamentals and the earnings come through at or better than expected to sustain these levels. If we see some economic weakness, if we see some earnings weakness, my guess is we'll move to the lower end of this 4,200 to 4,600 trading range that we've been in for, seems like forever, months anyway.